Welcome to This Explainer. Today, we're peering behind the curtain of modern finance to uncover a high-stakes, microsecond battle that's hidden entirely out of public sight. Imagine a world where vast fortunes are made and lost literally in the time it takes you to blink. We're talking about a realm where algorithms wage an invisible war over the physical infrastructure of global wealth. It sounds like science fiction, right? Well, it's not. It's the absolute reality of high-frequency trading. Now, you might be wondering, what if 96.5% of the stock market was just a ghost? We all kind of picture the stock market as this bustling hub of buyers and sellers, firmly shaking hands over shared value. But what if the vast majority of that activity is just an illusion, a mirage created by incredibly fast machines? In the industry, they actually call this phantom liquidity. It's this crazy idea that the deep, active markets you see on your screen might just vanish the very millisecond you actually try to trade against them.
Okay, let's dive into this. When you look at the historical data, the dominance is just staggering. High-frequency trading, or HFT, has completely reshaped the microscopic structure of our markets. Looking back at historical peaks, HFT dominated roughly 70% of consolidated volume in U.S. equities. And in the UK, their share of continuous trading hit a massive 77%. Across the globe, these algorithms became the undisputed titans of the public exchanges, basically overwhelming traditional investors with sheer speed and a relentless barrage of market messages.
To truly grasp the sheer scale of this phantom activity, just look at this incredible finding from the French Financial Markets Authority, the AMF. They monitored the CAC 40 index and found that just three high-frequency trading firms were responsible for nearly 40% of all orders. But here is the absolute kicker. They canceled 96.5% of the orders they submitted. No way, right? That massive 96.5% chunk represents liquidity that literally evaporates before a single human could ever interact with it.
Section 2. The math of the frontline Q economics. So why on earth are these algorithms canceling so many orders? Well, think of the market like the ultimate grocery store checkout line, where your spot is worth millions. At the very heart of electronic trading is the limit order book. It operates on a strict rule: price time priority. Basically, if you and I both want to buy a stock at $50, whoever gets their order to the exchange's computer server first gets to be first in line. In this environment, speed isn't just about getting the news faster, it physically dictates your spot in the queue.
Now, what's really interesting about this is how quants actually calculate the exact monetary value of cutting that line. The formula models the dynamic value of a queue position. It shows that the economic dividend of being at the very front of the line is so incredibly high that HFT firms will spend billions, literally billions, on dedicated hardware, microwave towers, and specialized computer chips just to shave off a single microsecond and jump ahead.
Let's break that math down simply. The value of your spot in line really comes down to a balance of two things: alpha, which is your fill probability, and beta, which is your adverse selection cost. If you are at the very front of the line, your alpha is essentially 1. You're guaranteed to get a trade. But if you're stuck at the back of the line, your beta skyrockets. By the time the market gets to your order, it's usually because a massive, toxic, informed trade is sweeping through the market and you, my friend, are about to get run over. Because being at the front is so incredibly lucrative, HFTs are constantly looking for loopholes. A prime example of this was the highly predatory hide-not-slide order type. An exchange called Direct Edge actually allowed certain HFT firms to submit hidden orders that secretly held their place at the front of the line without displaying it to the public. When conditions shifted, boom, these hidden orders would suddenly appear, effectively jumping the queue. This severely disadvantaged regular investors and ultimately resulted in the SEC hitting the exchange with a whopping $14 million fine.
Section 3. When the machines retreat, systemic risk.
So we've seen how these algorithms completely dominate the market during normal times. But here's the catch. Unlike traditional market makers who are actually contractually obligated to provide pricing, HFTs have absolutely no such duty. This makes their liquidity highly pro-cyclical. When the market panics, they don't stick around to help out. They hit the kill switch. This exact behavior has led to an era of terrifying flash crashes. Back in 2010, HFT algorithms collectively withdrew their limit orders in response to a huge sell-off, instantly draining the market of liquidity. Within minutes, blue-chip stocks like Procter & Gamble traded for a single penny, while Accenture magically hit $100,000 a share. We saw similar structural failures in U.S. Treasuries in 2014 and across ETFs in 2015.
So the crucial point here is perfectly captured by the SEC's deep dive into that 2015 ETF crash. When the algorithms collectively disconnected, the risk of an ETF pausing its trading spiked dramatically. Extreme volume surges increased the pause risk by 7 times, but more importantly, having a high correlation to the S&P 500 increased the risk of a pause by an incredible 21 times. The automated arbitrage algorithms that link ETFs to their underlying stocks simply snapped under the immense pressure, leaving everyday investors totally stranded.
Section 4. The Dark Forest. Decentralized Finance and Mempools.
Now, this invisible war hasn't ended. It actually just moved to the blockchain. In decentralized finance, or DeFi, the traditional limit order book doesn't even exist. Instead, pending transactions just sit in a transparent waiting room called the mempool. Because it's fully visible to everyone, highly sophisticated algorithms known as searchers constantly monitor it. They practice something called maximal extractable value, or MEV. Rather than competing on raw microsecond speed across fiber optic cables, they compute the exact order in which block transactions should be sequenced within a 12-second window, manipulating that order to extract risk-free profit from ordinary users like you and me.
And this brilliantly illustrates a highly predatory tactic born from this environment, the sandwich attack. It's basically a 1-2-3 robbery. Step 1. The bot detects a large user buy order waiting in the mempool. Step 2. The bot pays a higher gas fee to jump the queue, front-running the victim and buying the asset to push the price up. Step 3. The victim's order executes at this newly manipulated, much worse price, suffering serious slippage. Immediately after that, the bot backruns the victim, selling the asset for a guaranteed profit. The victim is quite literally sandwiched.
In this new decentralized world, the arms race has completely evolved. It's no longer about putting your physical servers as close to the exchange as possible. Instead, it relies on sheer raw mathematical computation. To execute multi-leg arbitrage across thousands of liquidity pools before a block closes, bots have to solve immense quadratic routing problems. As the complexity scales massively, it becomes a fierce battle of pure processing dominance rather than who has the fastest optical cables.
Section 5. Rigging the Game. Payment for Order Flow and Internalization.
All right, let's bring this explainer back to the traditional retail investor. You might be wondering, if public exchanges are so toxic and filled with high-frequency predators, how do normal brokers execute our trades? Well, the truth is, they don't send them to public exchanges anymore. Order flow is now heavily hoovered up by private dark pools and single-dealer platforms. This whole practice is fueled by payment for order flow, or PFOF, where giant wholesale firms actually pay brokers to route retail orders directly to them. Take a look at the fee asymmetry in the options market to see how this absolutely crushes true competition. If a wholesale firm's affiliated market maker executes the trade internally, the exchange charges them just 5 cents. But if an external competitor wants to step in and offer the retail investor a better price, they're hit with a 50-cent penalty. That is a 10x asymmetry. This structural barrier is exactly why a staggering 90% of retail options order flow is controlled by just 3 giants: Citadel Securities, Susquehanna, and Wolverine.
The dominance of these internalized private markets brings us to a fascinating piece of history known as the Griffin Paradox. Back in 2004, the CEO of Citadel, Ken Griffin, actually wrote a letter fiercely warning the SEC about the dangers of brokers internalizing order flow. He argued that it would leave only the most toxic orders for public exchanges, widening spreads, and ultimately corrupting the value of the public markets. It is the ultimate irony that the very practice he warned against is the exact foundation of his firm's overwhelming market dominance today.
As we wrap up this explainer, we really have to look at the big picture. We've traced the evolution of the phantom market, the million-dollar queue jumping, the terrifying systemic flash crashes, and the migration to blockchain mempools and private dark pools. All of this really forces us to ask, what is the true social cost of a financial system built on this relentless pursuit of microsecond speed? When vast fortunes are spent on hardware to extract pennies millions of times a day, are we genuinely improving price discovery, or are we just funding an invisible arms race with hidden systemic risks waiting to fracture? I'll let you be the judge. Thanks for exploring this topic with me today.